Warren Buffett has amassed a large portfolio of bank stocks for Berkshire Hathaway, with major holdings in Bank of America, Wells Fargo, and American Express. However, one lesser known Buffett bank stock, Synchrony Financial, could be the most compelling value of all. Synchrony is a major issuer of store branded credit cards and also operates a rapidly growing online banking platform after it dramatically underperformed the banking sector thanks to the loss of a key relationship. Now might be the time to put this dirt cheap Buffett bank stock on your radar for investment consideration. So let's take a look. Synchrony Financial posted third quarter earnings of 91 cents per share, which represented 30% year over year earnings per share growth. Synchrony's net interest income was 9% greater than a year ago, and the purchase volume of its credit cards increased 11%. Synchrony's online banking platform, with $8 billion of deposit growth in the company's high yield savings accounts and CDs, shows a 14% year over year growth rate. Although store credit cards tend to have higher default rates than standard credit cards, their higher interest rates more than offset the difference. In fact, Synchrony's net interest margin for the quarter was 16.4%, higher than most traditional credit card issuers. And because of the branchless banking model, Synchrony delivers some of the best profitable metrics in the sector. The bank's return on assets was 2.7%, and the return on equity was 18.5%, and both are much greater than the respective 1% and 10% financial industry benchmarks. While credit quality has become more of a concern recently with the rising consumer debt levels, Synchrony's net charge-off ticked up, but only by 2 percentage points, and the 30-plus day delinquency rate is actually 21 basis points lower than it was in the third quarter of 2017. Synchrony Financial has been of the worst performing stocks in the financial sector in 2018 thus far. The biggest reason for their poor performance is the loss of the company's store card partnership with Walmart, which is now set to expire in mid 2019. This is a big deal for Synchrony. Of the company's $60.6 billion in retail credit card loan receivables, Synchrony estimated that $10 billion is from Walmart. Synchrony stated that it should be able to fully replace the earnings per share impact. And based on the company's third quarter results, the recovery won't likely take too long. Plus, Synchrony is taking advantage of the stock's depressed valuation, having bought back about $966 million in stock during the third quarter alone. At a valuation of less than 9 times 2018's expected earnings, perhaps Synchrony deserves consideration. So let's take a look at the charts. We're looking at the monthly chart on Synchrony Financial, and the symbol is SYF. For disclosure purposes, I do not own any Synchrony Financial at this time. Now, this history doesn't go back very far. It goes back into 2014, but I think it's enough to get a pretty good idea of the cycle. And as you can see here, the cycle is fairly decent, going up and down, up and down, up and down. And here we are in a downward move. So let's take a look at what the oscillators show. And the oscillators show pretty much as the price chart shows. It is a relatively strong company in that it stayed above the zero line here with regard to the MACD. And based on the prior bottoms that we see there, and here, I would imagine that we'll try to set up another bottom here in this area. Looking at the histogram, that shows somewhat the same here with a very slightly negative histogram attempting a bottom in this area here, kind of as it did in these times in the past. Looking here at the price rate of change is relatively decent as well, above the zero line, And the fast line just came through the slow line here, but I don't imagine that we're going to see much more downside to that given what we've already seen in the price chart and in the MAC. Looking here at the RSI, somewhat the same. We've hit these areas here in the past, did not go below that line there. I think that's probably about maybe the 30. I'm not quite sure, but it's staying close to that 50 or midline, and I think it's going to do that again. Here into the stochastics look like they go a little bit further down, both in the fast line and the slow line, than they had in these periods here. But again, I don't think it's really all that significantly negative because it is only just slightly below the 50 or midline there. The volume looks fine. Nothing bad or necessarily all that good about the volume. I think it's just marginal. The Williams as well looks like a bottom here in mid 2018 with an attempt at a upward movement and recovery. Back up to the price chart. I think the cycle, although it's relatively short, only going back to 2014, I think you can take a look at that price chart, and those are fairly predictable cycles. So that might give you an edge if you're considering Synchrony Financial. But as always, conduct your fundamental analysis. And so for today, that's ChewDog Charts. Thank you.